thanks to LinkedIn and thanks to Mike. Thanks to Kim and Jennifer who prepped me and did everything here. And thanks to all of you for showing up today. You know, it's a funny thing. I am a complete idiot when it comes to technology. I really am. And so it's funny that here I am at LinkedIn. Please don't look at my profile. Not yet. Because I'm told that it may be among the worst profiles that a speaker at this event has ever had. So we're going to make that better, I promise. Okay, so let me tell you a little bit about who I am. So whatever, I work for CBS News. That's not really who I am. I started my career on Wall Street as a commodities trader in the gold, silver, and copper option rings of the New York Commodities Exchange. So where I say that the best thing that ever happened was the kind of sexual harassment training you had as one of 8 women with 800 men. First day, bra was snapped. I was like, okay, I'm ready. I know where I am. Late 80s, here we go. So that really prepared me for life in the financial services sector, didn't it? And it was a great experience for anyone who saw Trading Places. Yes, I was one of those people who did lots of this and that. And I quickly realized that although I'm sort of like an aging athlete, just making money wasn't exactly how I wanted to live my life. So I ended up moving into a traditional path of a financial advisor. And I owned a little teeny tiny investment management firm up in Providence, Rhode Island, which was really a kick because Providence is a crazy place and you can do pretty much anything. And because it's this big, if you kind of become famous, you become famous in a huge way. So we grew the business, and one of the ways that we grew our business was we hosted a call-in radio show, which then led to lots of TV appearances, which then led to me doing some stuff in New York because I had moved partially to New York, splitting my time. And I was working for Fox News Channel and CNN. And one day CBS called me up in the beginning of 2008 and said, producer said to me, hey, I just heard you on Fox Business News. It sounds like you know what a CDO is. And it sounds like you can actually explain it. And I said, I can actually, and I do know, and I can even tell you like how the Black-Scholes model has been created. And he says, don't go that far, really. So I started doing some work for CBS. CBS wanted to launch a bigger online presence with a website, cbsmoneywatch.com. And that's really where I became immersed with about a bunch of 20 to 28-year-old kids who taught me about what social media was all about, who got me involved, who obviously did not help me with my LinkedIn profile, but that comes later. And what I realized is that my training of being a trader, being an analyst, and most of all, being a salesperson. I mean, when you run a little company, you really have to go out there and get business, right? And you have to figure out how to do that. So you have to be really smart at being taking complicated concepts. Anything that you touch in financial services is complicated to everyone else, and translating that to the public, helping them get that knowledge base, trusting you, and then hopefully forking over all their money to you, which is really the end game. So I'm here to give you a little bit of an overview of the macro trends that are going on right now. And so let's kind of check this out. I love this quote. The IMF came out with a whole bunch of revisions to global growth this year. So we have the chief economist who says, we don't have a sense of the final destination, where we end. I don't have much of a clue. Are you kidding me? You're an economist? You have no clue? But I found out after doing this a long time that no one really does have a precise clue. You can sort of get general trends over a long period of time, but in the short run, who really does know? What we know right now is global growth is just above 3.3% probably. U.S. will probably grow by a couple percent, and China will be poor China, only growing at 8 or maybe 7.5% this year. Eurozone is still in a recession, is in contraction. We just got an ECB rate cut for anyone who's checking their iPhones this morning. Japan actually growing again, and emerging and developing nations up. So what I think is kind of neat is that last week I wrote a blog post and I sent it around to everyone at CBS News, and I said, the GDP was meh. And the guy who runs CBS News, the assignment desk, wrote back, stop with your financial jargon. I said, what? So I found this. I said, that is not financial jargon, okay? You know, this is what happens when you're 64 years old and running an organization for so long and don't decide to come into the generation that is now behind you. So I will tell you that it's meh. That's what it is. It's not great. I mean, it's great if you've had a job, you've kept a job. It's great if you have been able to reap the rewards of asset levels recovering, both the stock market and some housing recovery. But you know, for the average guy or gal out there, and I hear from a lot of these people, so there's almost 12 million people out of work. You can't be feeling so psyched about the recovery when there's that many people out of work. And you can't really be feeling so great about an economy when you kind of look at some of the factors that basically the business dating cycle looks at. So they look at GDP. All right. Well, GDP grew by, 2.5% in the first quarter. And we returned to the pre-recession peak back in 2011. But, GDP is supposed to be up at 3.3%. So at 2.5% or 2% for the last couple of years, that's meh. Jobs, we are still below our pre-recession peak. We need about another year and a half or 2 years to get back to where we were before the recession started. We've got manufacturing, industrial production still below pre-recession peak. Personal income. Don't ask anyone in the financial services sector this question. They don't like this. If you talk to your friends who got big bonuses or bad bonuses or whatever. But personal income is still down. And so when you talk to people and they're just regular people, if you look at the average median household income in this nation, wages are frozen for the last decade. That does not make people happy. That's a really tough environment in which we're asking people to operate. All right. So I love charts. I'm such a chart whore. It's ridiculous. So that was a bad recession, right? That was really horrible. And what we know, a lot of research does tell us, and as much as, I don't know if anyone here is following like the econo-blog smackdown between Reinhardt and Rogoff, these Harvard economists had said that there was if you had GDP, your debt to GDP was more than 90%, it was terrible. And we found out that they made a mistake in their spreadsheet. Harvard economists. I felt so good about that. I didn't have to get a PhD. But, they did some pretty interesting seminal research, if you ever want to read about it. They wrote a book called This Time is Different. They looked at 8 centuries of what was going on in the economy. And they found something that was really interesting. The kind of recession that we were just in, this balance sheet recession where we had a huge asset bubble that was blown up by lots of lending and lots of borrowing, and let's not place blame on anyone, it was just crazy. When you have that kind of recession and it implodes, it takes a long time to recover, much longer than any other kind of recession. How long? It's kind of scary. It's like 7 to 10 years before the economy really gets back to where we were. So if you think about it, the recession started in December of 2007. So we probably still have another year or so before things look like normal again. But it's still a very challenging environment. And I always think it's amazing because we have had new post-recession highs in GDP, but we just still, you ask the average American how you feel, even if they have a job and even if their 401ks have gone up in value, people don't feel good because there's just been such a bad, deep recession. At one point, we were down almost 5% from the peak. So it was for real. The next thing that we always like to look at is jobs. Again, similar situation. We're creating about 160,000 jobs every single month for the last 3 years. Is that good or bad? Is it good or bad? Come on, wake up, everyone. Come on. Good? 160 a month. You like that or not? You want a better number or not? Bad? Meh. Meh. That's our theme. It's meh. So it's like population growth, right? So the key with job creation is that we always have new people who are coming into the workforce, right? And we've got to keep up with that population growth rate. New people come into the workforce, so jobs created. We got to create about, like 125, 150 just to keep up with that. So why is the unemployment rate dropping? Because there's so many people who are just saying, I'm done with this job search, it's too hard. They're leaving the workforce. Our labor participation rate is back where it was in 1979, a year I remember, I might add. I really do. So we have a lot of people just leaving the workforce because they're either frustrated. For those of you in financial service from the advisory side, there's probably a lot more people saying, I can't go back and look for a job anymore. Well, you know what I'm going to do? Instead, I'm just going to claim my Social Security benefits at 62. I'm done. There's a lot of kids who can't get jobs. They're working part-time. They're working under the table. They're going back to school. They're living with their parents. It's phenomenal. And we just haven't seen this kind of persistent unemployment for such a long time. It is a once-in-a-generation situation. We still have a jobs crisis. Everyone here has a job, so I always feel weird when I talk about that. But it's good to be sensitized to where we are, right? You just need to know the environment. So we have about a year and a half to get back to all those jobs that we had before this started. So let's go to everyone's favorite topic, especially those of you from the Bay Area. You always love to talk about housing. I love that. All right. Housing is probably the epicenter of the crisis, right? So that's where everything happened. Prices nationwide are still 29% below where they were at the peak, which was like 2005-06. And in some areas, things have come back even better, maybe 20%. In New York, we're 24% below peak. But that said, something really interesting is happening in the housing market right now, which is so cool. Because we've had basically since 2006, every year since last year, so for those 5 or 6 years, housing was pulling out growth from the economy. It was contracting. We were losing tons of construction jobs. People were going crazy. The foreclosure pipeline was filled up. This year, we are going to see housing make a positive contribution to the economy. That's huge. And in fact, when I look at the GDP report that was just released, we saw that residential investment, so that's new single-family structures, multifamily homes, home improvement, and commission on existing home sales. You put that all together, we call it residential investment. We saw that go up by 12% in the first quarter. That's a huge number. It's really great. Okay, so what do you want to tell? You want to know about the bad news? Here's the bad news. Housing starts peaked in 2005, over 2 million homes. Last year, we averaged about 770,000. We got a long way to go. I'd say we've tried to get back to 1.5 million. You know, when you think about the housing crisis, we really are not going to get back to the peak because that was a steroid-induced peak, right? I mean, I'm an athlete, so I'm going to keep using these analogies. Sorry, guys. You know, when you see a player, just hit an enormous number of home runs after not hitting as many home runs for 10 previous seasons, you start to say, what's wrong with the numbers? That's what I think about with the housing market. You can't go from an average of 1.5 million new homes over a 20-year period time horizon, then get to 2 million just by accident, right? It happened because of all of this easy lending and borrowing. Part of that goes back to just a general amount of tons of cash in the world looking to get more return and get more yield. So we packaged up all these mortgages, and there you have investors in Luxembourg saying, I must get a bond with lots of homeowners paying off these things. Yes, we will create that for you. It's all fun, right? It's all fun until it doesn't go well so much. And so what we do know is that we have a long way to go in housing. I think that we'll probably have a few more years. It's going to be spotty. It is going to be the good old location, location, location. It'll start to be a more fundamentally driven market. It will continue to be hard to get a mortgage. And you know what? That's a good thing. You don't want a lot of steroids. We want the game to be a pure game. We want people to borrow money who can afford to repay it. We want banks to lend money when they feel comfortable holding that risk, right? Well, we'll get to the banks in a second. So we had a Federal Reserve meeting this week, and we had an European Central Bank meeting today. And what are they doing? They're printing money. It's beautiful. I love it how it comes out like that. I want one of those. Okay, so why is the Federal Reserve acting so aggressively? It was very funny. An anchor at CBS Radio just gave me a 5-minute diatribe about how the Federal Reserve is ruining America. I take a different view. You know, I was not a fan of Alan Greenspan. actually think that maybe Bernanke's a pretty cool guy. Generally speaking, when you have a huge recession like we had, what do you have? You've got three parts of the economy, right? You've got consumers, you've got business, and you've got government. So when consumers and business basically fold up shop and contract enormously, who is left to come and fill in the gap? The government, right? So that's why we got this big stimulus bill. Don't go political on me. That's why we got it, okay? And whether it was done best way or not, I don't know. But usually when you have a huge recession like that, there is only one party that can come to the table and spend money, and that's the government. So what has happened, which has been a sort of a fascinating transformation, is we spent the money here in the U.S. There was some money spent in other places, but because this was a debt crisis, there became a renewed effort to be very concerned about the debt and the deficit across the globe. And no, we're not going to become Greece, I promise. But what I should point out is that this hyper-focus on the debt and the deficit has meant that the government had to pull back on spending, right? We just now finished a 6-month period where government spending declined by more than it has declined in all the years since the end of the Korean War. That's pretty dramatic. And we ain't out of the woods yet. So Bernanke and company basically says, wait, the economy's not done yet. We've got this meh growth rate. We got bad job creation. There's no inflation. We got to start pushing money into the system. So what happens is that from their point of view, they don't explicitly say this, but they basically say, we're going to drive rates down so far that you can't leave your money inactive. You know this. You got money in your bank account and you got money in your checking account and you say, oh my God, it's earning zero. Like I am paying for this privilege of the bank holding my money, right? And then you start to think about other things to do with your money. Well, taking that in the bigger picture, banks figure we got to do something with our money. We're going to lend it. We're going to do something. We're going to build something. Hasn't exactly, we don't see that businesses are spending that much money, but the Fed clearly believes that it is the last actor that can prompt economic growth. And so what they have really done is something that's unprecedented. They had 2 rounds of buying bonds or quantitative easing. This last third round, $85 billion every single month in treasuries and mortgage-backed securities. And when is it going to end? Not sure. Not so sure. It's a fascinating thing because it's really, some are calling it QE infinity. You just don't know when it's going to be. So I think that when central banks are pushing money into the system and interest rates are really low, a funny thing happens. You know what happens? Rainbows occur. It's the rainbow connection. So beautiful. So here's what has happened in this recovery. Corporate profits have just been astounding. They've been unbelievable. And if you look back to the end of the recession officially ended June of 2009, right? Stock market bottomed in March of 2009. The S&P 500 was at that great number, 666. I don't know, take what you want out of that. And corporate profits start to recover right around the end of 2009. Now, doesn't that make sense? I basically lay off every single possible person in my organization. I stop spending on everything. And then incrementally, if the economy just stops sucking, then I will make money. And that's exactly what happened. Did you like that? Stopped sucking. That is a very official, get that on the highlights reel. So what is really interesting about that is now we go into 2010, 2011, 2012, even this first quarter, and we see companies are really profitable. Why is that? Why are they doing that? What is amazing about this to me is that companies are really making crap loads of money, but they're not hiring. And why are they not hiring? Because if you talk to CEOs, we're going to talk to one this afternoon, but a lot of CEOs that I talk to when I interview them, they say, look, I don't have to hire. Why should I hire if I don't have to? Yes, part of that is technology, but it's also just learning how to do something different at a time of crisis made a lot of companies realize, oh, maybe we don't have to go back to the old way, right? So as the economy gathers steam, all that money flows to the bottom line. That's a pretty good deal. The only problem is it does breed a little bit of discontent among the people. And here's why. Because right now, if you look at the recovery, there's something wild that happened. Usually when we have a recovery, who gets the fruits of the recovery? Everyone, right? We're all kind of happy about it. It's like everyone's doing better, jobs are created, wages are rising. That's great, right? Not so much this time. If you look at this recovery, the fruits of the recovery have gone disproportionately to who? To capital, to shareholders, to the companies, and not to wage earners. Now, why should you care about that? If you're a shareholder, you shouldn't, well, I don't care. I work for a big company and I'm making money. Isn't that good for me? It's not good. Because an economy that we want to see is where everyone's participating. I'm not a socialist from Brown. I did go to Brown, but I'm not a socialist. It's just proven fact that the more people that participate, the more robust the economy becomes, right? More people feel better. They spend more. They get out there. You have more people who are saying, yes, I would like to actually save money. But if your wages are stagnant over the last 10 years, what are you using to save? What is going into your IRA account? What services do you need from the financial services sector? You want people to participate. So what has been very interesting is it's been great for the profit margins. It's been great for the stock market with indexes doubling, right, since 2009. Not so great for the employees. And I actually think that that's not a terrific scenario long term. So it's one area where I think, wow, it's not just wage disparity, which is blown out, obviously, but it's the fact that you really want an economy running on all cylinders. You want a lot of people doing well. And until we get that, the recovery is going to be subpar. Which now brings me to the winding road ahead. You know, I have like a love-hate relationship with financial services. I'm from the business, right? I kind of grew up in this. My dad was a trader on the American Stock Exchange. I spent summers clerking on the Amex and the New York Stock Exchange. And I love this business. One of the reasons I love the business is that it's so crazy and emotional. And that's what I learned when I became a financial advisor, which was, it didn't matter how smart I was. It didn't matter whether I knew how to calculate a Black-Scholes model and explain it to somebody. What mattered is that you were sitting in front of somebody who's freaking out or greedy beyond belief. Because there's really only two emotions, right? Are there only two emotions in financial services? I used to say it's fear and greed, and then someone told me maybe regret. So I'll say three. So fear, greed, and regret are our big three emotions in financial services. But it's emotional. I mean, when I sat around the table from people who were really just going bananas during the internet boom. And I would say, we had a great year, we made 21% on your money, and I got fired. Why? Why are you firing me? I thought you were a balanced investor. Well, no, you should have told me to take more risk. I said, but you didn't want to take more risk. You just wanted to be a balanced investor. Remember, I have my notes here, see? Because I'm a good compliance girl, I keep all my notes. And, you know, it was fascinating to watch people shift from greed to fear. And, you know, the funny thing about financial services, it's not that, you know, some people can really do this themselves. Some people can manage their own money, and they're great at it. But the people that need help and don't have the discipline really need to feel like someone is listening to them and hearing what they are feeling and understanding who they are and delivering to them what they need. They do not need an 80-page financial plan, which is exactly the length of my first financial plan that I delivered to a client. And at about page 6, it was like, I have no idea what you're talking about. So what I think is really important about when you think about financial services is to remember that at the end of the day, I know that there's some of you out there who work for companies that create product. There's some people who are service-driven. There's some but no matter what, at the end of the day, financial stuff is so murky to the average consumer. It's so hard to comprehend. And the most important thing that you can do as an organization is to understand that people will not, they just can't take in as much information as we all have to give to them. They can take away a few things, a little bit at a time. Or as someone once told me in news, if you watch a segment on the CBS Evening News and you remember one thing from that segment, then we have succeeded. So think about that as an interaction with a potential financial services client. If they take away one thing from that message, you have succeeded. And you may need to deliver that message a few times to get them to remember that one thing. Obviously, I want to just touch on the regulatory environment, which has obviously become more difficult. Are there any compliance professionals in the room? Look at the poor lone woman like, oh, me. I'm married to a compliance professional, so you'll be happy to know I love the regulatory conversation, which goes something like this. The banks are so bad, honey. They're bad. And she turns to me and she says, you just don't understand the regulatory regime. You don't understand the pressure that we have to work under. And so I do get both sides of it, right? But we know that there are going to be limits that are going to be imposed. And I would challenge everyone in this room to think about all the preceding information that I gave you and just take a step back and now put your consumer hat on. Be a person for a second. Be the guy who sells advertising for Time Warner, who lives in the city or lives in the burbs and has a family, who makes with his wife a couple $100,000 a year, who is paying more in taxes in the city, can't afford to send his kid to private school, so is doing the whole public school thing here, and is trying to figure out who he can trust with his $400,000 rollover from his past job. And this person does not want to hear that banks are trying to water down regulation. This is the messaging that person is hearing. So what you need to know is, as much as you've got big, huge operations that are running, that are fighting regulation, again, think about it from the consumer standpoint. Do I want to work with a company that's sort of out front and saying, look, we get it, we know what you want, we're going to deliver that to you? Or do I want to work for the company where I hear, oh, every 3 weeks there's someone lobbying to make things easier for the company? No one cares about our companies. Nobody cares. They care about themselves, right? So regulatory, and don't bring up regulatory stuff in cocktail parties. Very bad, very bad. Nobody wants to hear about it. So we don't want to discourage innovation. But I also think that it's important for us to recognize, being of this industry, that we need some regulation. We screwed up. It was bad. And we are not self-regulating. We are not good at that. So, when there's a big accident, we put up a big traffic light, right? And to some extent, we have to acknowledge that the traffic light's going up. We need it to control the traffic flow. And we don't want to get it ripped down so fast. It won't look good, believe me. All right, let's get into some of the fun stuff. I told you I was a salesperson, so I just love this idea. So mass affluent, we're going to talk a lot about that throughout the day. Net worth excluding your residence of about $100 to $1 million. Now this was my favorite kind of client. When we pursued clients, we didn't do 100,000. We did more like 500,000 to 2 million. That was our bread and butter when we were managing money. And the reason why I love this mass affluent is that basically they have needs that no one's addressing. Just a quarter of them work with advisors. They don't really want to be involved. They want, a third say, I want to be involved. A bunch of them feel very insecure about their retirement, and a lot of them are worried about what's going to happen to their kids. So I find that this group is a really interesting group, and as much as I gave you bad news about the economy, there's a lot of people in this group, a ton of people. And those people are very engaged with the technology revolution. They know what meh means. And I was just intrigued because I think that of these people, what we know is that they are starting to engage in social media in a pretty dramatic way. So obviously they are all having beautiful LinkedIn profiles, right? And they're really, really good about staying on top of that. I've been pleasantly surprised, actually. Some of my parents' friends who are saying, "Oh, you didn't pick up my LinkedIn request." I was like, "Oh, okay." I'm also sort of fascinated by what's going on. It's it's the good news, bad news for the news business, but it's interesting from the financial services. You should know this, that about 2/3 of people with a TV and some other device, mobile phone, laptop. They're multitasking while they do stuff. So CBS did a big push for social media for the NCAA basketball tournament. And we generated over 16 million social media comments about the NCAA tournament. And that was a 112% increase over last year. It was huge. Nielsen says that if you've got a Twitter presence for a network, it actually increases your ratings. It's wild. So an 8.4% increase in Twitter volume correlates to a 1% rise in new shows among viewers 18 to 34. Now, it takes a little bit more, but you know what? You can actually get the 35 to 49-year-old demo to help your ratings as well. And these are, many of them, the mass affluent. These are the people that want financial services. And I know that you all want to tap into the explosion of social media. You just got to figure out that, which images break through. Don't try to do too much. Remember that one thing. There's only one message out of every video. Don't do too much. The business opportunity that I also want to talk about is chicks. Women make a lot of money and control a lot of financial decisions. And I thought this was kind of wild. I think this comes from Allianz, the big German insurance company. And they did a survey and they said to women, well, how do you feel about financial services? And they basically said it's geared towards men. And it's geared towards men because there are more male advisors, but also because men don't seem to really ask questions of women that women want to be asked and don't communicate in ways that women want to communicate with them. And I think that this is really interesting when you think about social, because if you think about how women share information, get information from one another, share advice, share tips, bring news to each other, there's something missing in a big way with women and financial services. And, so again, as one of 8 women on the floor of 800 men, I can tell you that that's not the odds you're up against, but there aren't enough female voices out there that women are responding to. And that's kind of interesting to me, and I think it's a huge opportunity, huge. How are you going to break through with this? How are you going to break through with all this? I think that's a critical question. We have people who are using multiple platforms to get their daily news. I'm sure very few people in this room are watching the CBS Evening News every night to get your news, right? You're checking your phones all day long. You're checking the internet. Maybe you turn the news on in the morning when you wake up to see the weather. That's great. But what's really been interesting in terms of the way we see news distributed from the network level is that we see that when we put a piece on 60 Minutes, that does really well. When we started to create a platform for that to be shared across the digital platform and through social and through iPad content, it was explosive. It was like a whole new generation of people absorbing the news that would never turn the television on at 7 o'clock on Sunday night. So in many ways, I think this is a wonderful way to distribute great content to more people. That's the exciting part. But you do have to break through. And you have to break through in a way that people can really take in. And I think that that's sort of the big deal here. I just find this mind-blowing. So 165 million people are going to be regular users of social in the next couple of years. 165 million people. All right? Of course, we now know 2/3 of them are multitasking while they watch TV. But here's the part that I think is really awesome. They're younger, they're participatory, they are raving fans. They love the people they love, and they will do your work for you. They will prospect for you, basically. And it is a wonderful way to create some brand, whatever your brand is. This is a wonderful way to engage with people. And I think that why this is so exciting to, sort of an old school financial advisor like me is like, this is the keys to the kingdom. You can tell your total prospect audience, who you are. You can deliver information to them. They get a sense of your personality, and all of a sudden, they come to you. So I have a really good story about this because CBS owns a CNET, which many of you probably know about. So CNET is our technology website. And there's a couple guys who host a podcast on CNET, which is just a kibitzing website. I mean, a podcast. They literally just get, every day they get there and they say, oh, what are we going to talk about today? And they just talk. It's like Morning Joe podcast for 22-year-olds. So one day they asked me to come on the podcast because they had questions about something going on in the financial world. And I went on the podcast and I started to talk to them about things that they wanted to hear about. Well, I just started my 401k. What do I do? How do I do this? And I started going on this podcast every few weeks or so. And I got this huge bump up in my Twitter followers. And at one point during one of the shows, I made a joke that I was so old that I could be their mothers. I said, oh, yeah, I could be your mother. This is ridiculous. And they said, nah, you're not my mother. You're my aunt. I said, oh, okay, like I'm the cool aunt. All right, that's good. I'll be the aunt. And the followers of their show created a hashtag Aunt Jill. And then they started sending me questions. And there was a fascinating snowball effect here. So check this out. This probably started about 2 years ago. Not that I have so many Twitter followers, but I mean, decent. Everyone follow me on Twitter. At Jill on Money. And what was fascinating is they would tweet a financial question that, pretty easy stuff, nothing too complicated, but they're an interesting demo. And when I launched my weekly syndicated radio show, they would tweet a question, and then I would forward it to my producer, and I'd say, get this guy on the air. And all of a sudden, I started to have radio callers. I mean, talk radio is like, honestly, the demo is 50 to death. And so getting someone who is 22 years old, who's a software engineer in San Francisco making $82,000 a year, sounds different on the radio. So about 6 months ago, a program director from one of the stations calls me up and says, I got a question for you. How are you getting these young guys listening to talk radio? I said, oh, those are my podcast guys. And they started following me on Twitter. And then I got them to download the podcast of the radio show, and now they're radio callers. It was like the most beautiful combustion of every platform. And it worked so well. And so where did it go back to? It was I spoke to them in a way that they could hear, that I could give them advice. It became trusted advice, and then it snowballs. And that is the goal here. Your financial companies, this sector, I know it's filled with tons and tons of smart people. That's great. If you can't figure out how to communicate to people in a way that they can take that message in, it's useless. It's totally useless. So I think that there's great opportunity. We just got to figure out how to get you all there. And with that, what I would like to do is bring up the lights and open it up to some questions. And it can be anything from, an economic toughie to an easy one, like, layup, like I'm 5'11". That's the big question I usually get. So if there are any questions, no, come on, get some questions right now. Someone's got a question. Here we are in the front. This guy looks like Jared Bernstein, the economist.
I am.
Ah.
Now, my question to you is, all right, I understand that the here and now is meh.
Right.
What's your prognosis for the future in the coming years ahead, say the next few years? What's your outlook?
I think that in the coming years, I think we've got to get another 18 months under our belt. And then I think we go back to trend growth. And trend growth would mean 3.5% growth. Something will come around the corner to surprise us, but do not underestimate how deep of a imprint that recession will leave. It's sort of an interesting thing. When you look at data now, you can see that people are, they suffer from recency bias, right? Whatever just happened will influence what they do next. That's why kids who come out of college during a bad recession make so much less than kids who come out during good times, because they are not risk takers. They're scared to leave a job, even if it's a rotten one. And so that will keep a bit of a lid on things. And look, the housing stuff is going going to take a while. So I think we have a couple more years where it gets a little, still tough. But I think 14, 15 is when we start to see a much brighter outlook. I will say this, that for people who did not lose their jobs and are investors, they're feeling okay. And you've just got to give them permission to make different decisions about what's going on in their life. That's the thing that is very difficult. Because even if things are going well for you, you're still infected by the bad news you hear. So it's hard to make that shift. But I'm like Annie. I think the sun's going to come out tomorrow. It's going to be a good thing. I could sing.
Hi, I'm Megan Kelly from Fidelity Investments. Thank you. This has been great. A question about what your thoughts are on the impact of social to move markets, like we've seen recently, and how do you create trust in a channel where not all the information can or should be trusted?
Yeah, I think that's a great question. I was on a panel last week for SIFMA, for the Securities Industry and Financial Markets Association, and I was sitting on a panel with some other journalists, and I gave a huge plug to Hearsay Social. And I said, if you guys are all so freaked out about information, then spend a few bucks, because there are technological solutions that actually exist, and every major news outlet should not be allowing tweets to just go out unfiltered. I think it's ridiculous. And I think that if you want to maintain the sanctity of what you're doing, and that's all you have as a news organization, you can't let that happen. So I don't, and you know what, look, I'm not a real journalist, right? I'm an analyst or whatever, and I've only been doing this for 4 years. I think it is pathetic how they all die to get out there first, because it doesn't matter. It actually doesn't increase your ratings. So if that's the case, then what are we doing here? We're all chasing our tails for no reason. I think the SEC is going to have a big problem, because the SEC just comes out and says, yes, you can have corporate communications go out via Twitter, right? It's full disclosure. Well, I trust financial service companies more to monitor their Twitter accounts than I do the news media. And so I'm wondering whether the next step will be, and the next iteration will be, that news organizations have to get a little bit more serious about how they manage their social interactions. And by the way, kind of makes sense. You have some errant anchor just dropping F-bombs on Twitter by mistake, thinking it's a direct message. Like, that's just stupid. So it wouldn't be a bad thing. And in radio, old-time radio, we had a dump button. There's a 7-second delay, the Howard Stern button. And it was great. It was real, and I used that a couple of times. So, former commodities trader, remember? So I think that a little filtered content is good. I really do.
Great presentation. Lewis Goldman from MetLife. Income inequality, I think, is at the highest level since the 20s. And I've read some economists talk about it, how you need a much less income inequality to be able to have sustained growth. I'd like to get kind of your perspective on that, and whether you think that's something that's going to be solved or something that's going to have to be overcome to get back to 3.5% growth.
I think it's huge. I really do. I just don't think it's good that wide swaths of American people have wages frozen for 10 years. I just don't think that's good. And it's funny. I remember having a interesting conversation. It was the spring of 2009, and we used to have these all the correspondents who cover financial stuff and all the executive producers of all the shows would get together once a week, because things were just moving too quickly. And one of the executive producers, who's no longer with CBS, said, well, things will just come back and it'll just be regular. I said, it's not coming back like that. Because we had a 2-decade period that prepped us for this moment. And in that 2-decade period, what was happening? In the 90s, we had a recovery where everyone participated. We had an internet boom and bust. And in the 2000s, that is when income gains started to slow down for the middle class, or the median income. And that's when people started to try to live bigger by tapping into the equity in their homes, right? They made up for the fact that they weren't making as much money, and they borrowed and they looked, and I'm not making a judgment. It's just what happened, honestly. And so I think we are going to probably need a good decade here where people get back on their feet, crawl out of their balance sheet problems, and we start to see something happen. I think from a policy perspective, it's going to be really hard. Did anyone here see the Frontline broadcast about the retirement It's like, I forgot the name of it, but it was sort of like, the retirement disaster that's looming. And I think that this is something that's really important because one of the reasons we don't want income inequality is that we don't want a generation of people retiring in poverty, because we're all going to pay for that. So we need to try to fix that. So I think that unfortunately right now there's no government spending on anything, right? So you can just sort of shut that door. So now we have to wait for organic growth to happen. I don't want to be like a Debbie Downer. The next thing happens and it surprises you, right? But I think it's going to take a while to come back from this one.
Thank you. Hi, Nicole Maestri with BlackRock. What do you do on Twitter when you get financial questions that can't be answered in 140 characters?
Fabulous. I say, it's a great question. What I say is I write back and I say, send me an email to askjill@jillonmoney.com. And they do. And I'll either answer it via email. I mean, look, I'm not a registered investment advisor anymore. I still hold my CFP because after that goddamn test, I'm never taking that again. So I'm not letting that lapse. So that was not fun. But I'm also very sensitive to the fact that I'm not a registered to give advice. So I often will couch my advice in, you really should talk to this person, or I'm not a lawyer and I wouldn't know that. This is what I think, but you should do this. I always write my email as if my girlfriend, the compliance officer, is reading it, because I think that that's a very safe way to proceed. I also think what's interesting is that, look, I'm in the media now, so I'll say stuff and I get hate tweets sometimes, which kind of bums me out because I'm like hypersensitive a little bit about that. But what I really did learn is that oftentimes when you get like a nasty remark, a little flame here and there, it's pretty cool to engage. It's pretty cool to diffuse that. Like, wouldn't I rather know that than to have someone say, oh, I heard that girl say da-da-da-da-da, she's such a ya-da-da-da. I would rather be able to take it on. And what I'll often do is especially if I get something that seems a little anonymous, I'll say, I would love to have you come on my radio show and articulate your point. That would be so great. And you don't even have to use your real name. And 9 times out of 10, they're like, oh, thank you so much. And they'll send a nice tweet out after. Like, just talked to Jill on money. That was so cool. Because I do care about that. It's funny. In my career today, I treat all of these people like they were my clients. I really do. And when your client sends you a nastygram, what do? You don't say, delete. You say, I got to deal with this. I have an unhappy client, and I don't want an unhappy client. I mean, look, they're a lunatic, so I don't apply. The best thing is that when I first started blogging, I would put the exact same blog. CBS and HuffPo had a content sharing agreement. So we would put the exact same blog on HuffPo and on CBSNews.com. And when it was on HuffPo, I was called a capitalist pig. And when it was on CBSNews.com, I was called a socialist. And that is winning. The exact same content is viewed through the prism of the user. So you just ask for more information. And by the way, how cool is it if you do get something like that because someone is now asking for further engagement? I love that there are women asking questions because oftentimes I'm in these kinds of situations and only the pushy guys ask questions. So I like that.
Hi, Kathy Stahl from PIMCO. So PIMCO, we're very familiar with the meh outlook. We're safe there. But a lot of financial advisors have a hard time with it. After so many years of Debbie Downer, they want to be positive to their clients. So how can we help them deliver a realistic, disciplined, but not Debbie Downer message?
Well, I think that that's a great question. I would say this. You always have to be honest with your clients. So you can say, look, I don't think the economy is doing so great, but that doesn't mean you can't make money. Because in a meh environment, there's still tons of people who need your help. And look, if you look at the average advisor who is selling a PIMCO fund, yes, they're making money because they've sold that fund or an asset under management model. But why are they keeping their client? I guarantee you they are not keeping that client because PIMCO did 8%, 6%, or 4%. They are keeping that client because they should be working their butts off to have that relationship and say, who are you? What can I do for you? You are about to make different financial decisions. Let's go back and talk about your original goals. How are we going to get you where you want to go? So if anything, I think this is an awesome environment to steal clients. I mean, that's the pity of where I am in my career is that If I were an advisor in 2009, I would have been an animal stealing business because I would have said, no one wants to talk to you, but I want to talk to you. We used to put a billboard up in Providence, Rhode Island on Route 95, if anyone's from New England, right near the Blue Bug. And it was beginning of 2002, and the billboard said, open your 401k statement. That's all it said. And our phone number. We didn't even have the name of the company. It was like in tiny print. And we got flooded with calls because people said, oh my God, I haven't opened my statement in 2 years. How did you know that? It was just funny because somebody said to me, I remember talking to a client. This is where the best marketing ideas come from, right? Your clients. And I remember sitting with a client and I said, so what's the value of your 401k? And she said, oh, I don't know. I said, what do you mean you don't know? She goes, I haven't opened a statement in 2 years. I said, you haven't opened your statement? She goes, oh, I didn't want to know. Okay, so I think that in a meh environment where no one really wants to talk to you, it's the best time to engage. You know, it's a joke. Everyone at CBS Radio makes fun of me because they say that I get much more animated when the market is tanking than when it's going up. It's just true. Because I think there's awesome opportunity there. And people really want to know that you are taking care of them. People are not, I love Fidelity and Vanguard and PIMCO and all these companies that are great. It's honestly, you're all great. You've all got different things to deliver. You better hope that the people that are out there giving advice to the end user are engaging. Because if they are not, someone like me is going to come get them. That's the deal. Someone is always going to get them. So you have to constantly engage. When we first started being on the radio, other advisors are like, oh, you're nuts. This is so much extra work and blah, 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 blah. That's how we grew our business. We had a call-in radio show. And what was fascinating is we just realized, wait a minute, when you're on radio and you're just talking, you are literally letting the public try your service before they buy it. It's sort of the same thing with social media. They're trying to get a feel for who you are as an organization, who your advisor is as a person, and they're getting a sense of you. And it makes them more inclined to want to work with you. So when the world's meh or in a downturn, I think it's the best time to go out and talk to people. No one else wants to.
Hi, what do you think of the oil boom in America, and do you think it's really going to change anything?
Well, I think it's pretty awesome. I mean, look, if you take a look at the U.S. economy and what's happening, it is a phenomenon that is really going to, part of the expression, fuel growth. The question will be, what kind of limitations and regulations are going to impact the sector? But I think it's pretty awesome to think that the United States could be energy independent. It doesn't mean that that's good for all the green people out there. Like, yes, we are destroying the environment. Let's all just pinky swear and say, yes, we know that. And it's good for the economy. So I think it will continue to improve. I don't see how you fight that one. It's like, yes, it's bad for the environment. And yes, it's good for the economy. It is an unabashed positive right now. I would say that industry, healthcare is also one, technology, of course. And housing, just because housing is coming from such a low level, that's why everyone's talking about it. So it will have an outsized contribution to the economy relative to what we've come from. Anyone else? Have I run over my time? Do I get the gong? Oh, here's another question.
Rachel Burkell from Wells Fargo. Can you speak to some of the industry bashing, the consumer sentiment industry bashing that's happening, and your perspective on, whether that's still on the rise or starting to fade, or
look at my smile. I mean, it's like I could have planted this question. It's so good. Thank you.
From another woman.
I meant to cover this. So I have a friend of mine who works in financial services, and I went to talk to her team, and I said, let me explain to you what you're up against. You're not up against so much the public. You're up against a news media that despises you. They just despise you. And I found that out because, look, I'm the critic. I'm such a contrarian. So in the bull market, when the news media is saying, rah, rah, everything's great, and I'm like, oh, they're such idiots. I hate them. And I hated everybody. And then when the crash came, I I got into a brawl on Fox News Channel with somebody about the TARP program, because I said, look, you don't want the financial system to go down. No one wanted this, but this is what is necessary, right? So we're going to do that. So where I think we are today is I think that it's certainly softening, okay? But it's really hard for the news media to get their heads around what you guys do. They don't get it. And so what they'll do is they'll extrapolate the worst possible story, because that's what makes a good story, right? I mean, that's their shtick also. And it sells. So, for example, when you looked at, here's the best example. I'll probably get in trouble for this, but we're not going to release this to too many people. When we looked at last year, was everyone here last year? A lot of people here last year. Meredith Whitney spoke, and she's a big muni bond person, and she went on 60 Minutes and talked about how the muni bond industry was going to implode and it was going to be a disaster. So I called somebody in CBS News and I said, you must have someone who gives a counterpoint to that. That is an opinion, that is not fact, and you're presenting it as fact. And I know a zillion people in the muni bond business who are not seeing that. And she may be one opinion, and maybe it is going to happen, but you can't let that go out there. And they did. And I felt like that was wrong. And I felt like that's very emblematic of the industry, which would prefer to tell the bad story than the good one. So here's your lesson in that. You got to cozy up to some of these financial journalists and do it on an ongoing basis. You cannot do it just when it's hitting the fan and just when you want to just tell your good news story. You have to provide them with fodder, right? I mean, I showed you a chart from Allianz. Is anyone here from Allianz? You're from PIMCO, so that's close. You know, I'm like thrilled with Allianz. I don't know if they're a great company, but they send out some pretty cool research. So it makes me inclined to want to call them and ask them something when I'm working on a story. So what the news people want is they want information. They want you to help them craft the story, but they don't want you to spoon feed them your story. You got to be honest with them. And the other thing is, look, a lot of these people, they don't understand, like, as I said, since they don't understand it, the more background you can provide and context, the better. Now, that's the news side. On the consumer side, look, people still want help, right? They really do. And they want to know that you are an organization that, number one, acknowledges that you screwed up, number two, gets what the consumer wants and understands what he or she is facing in this environment, and is delivering the goods. So, you know, when people say, oh, you know, someone asked me a question like, oh, why are you so mean to me about the, you know, as a PR person? Why are you so mean to my company about that? I said, because you did something really bad and you won't admit it. So if you admit it, I'll write that you admitted it, and that'll be fine. But if you don't admit it, then I'm going to keep writing about it. So either cop to it. Now, this is really hard because if you have litigation departments, they don't want you to admit anything. But you have to at least be big enough to understand that there is another side. And the consumer doesn't really know what that other side is, so tell them. Tell them what your side is, and be honest about it. I always thought that the worst thing that the financial services business did in the aftermath of the crisis was to fight the regulatory movement. I thought it would have been a much more genuine thing for someone to come out. I had a huge battle with the guy who used to run SIFMA, this Ryan, and I said, why don't you adopt a real fiduciary standard? Come out for it and get all your members to come out and be fiduciaries, because that's what everyone thinks that they're doing right now. They think they're working with people who put them first. And the fact that you keep shucking and jiving around it makes people mistrust the professionals in the industry. So I know it's a pain in the neck, and I know it's going to hurt your business in the short run, but I guarantee you in the long run, you're going to get more business. It's going to be better for you. And he's like, that's ridiculous. We adhere to a fiduciary framework. But that is such baloney. Everyone can see through the Swiss cheese. So the fact that nobody really wants to do that is a problem, I think, because it really does show that there is an industry that is unwilling to give on the basic premise that when I, the client, walk into your office, I know you will put me first. I don't want to walk into a doctor's office and say, oh, this person says that I have to go get 500 tests because they own the testing center, right? I don't want that. The medical profession actually banned that a while back. They did do it for a while, though. I think that that's a really important fact. I go on my radio show every single week and I say, do not work with anyone who's not a fiduciary. I will be honest with you. It doesn't mean that I don't think there's great commission-based people. There are. But if you need a quick litmus test and you're a consumer, what do? What is the best way? What's the best advice you would give? You all come from the industry. I went and give a big speech for Morgan Stanley people, and I had a bunch of people come up after, and I was like, oh my, who said to me, I would never work with a Morgan Stanley Smith Barney broker. I would only work with a fiduciary. So I think as an industry, this would be the most amazing thing if we could come around to it. I know half the people here are like, stop talking about this, and I'm getting this sign. So I'm going to end on a positive note. Stop it. I love the industry. I think that, I think that there is a public that is really desperately in need of services, of understanding, of an industry that wants to help them out. It is a confusing time. I think that as you navigate the social landscape, the digital landscape, the traditional media landscape, at the very end of the day, it's just one person at the end who's taking in your message. And it's a person who has felt beaten up in the last decade. So if you remember that, there's your one thing to remember, is that we're going to put that end user first, that one person, and that's kind of your key to getting your message through. And even if you are a commission-based person, you can still make a good living, and you're going to probably do right by your people. It's just that I think it's easier if everyone walks in and saying, oh, I get the landscape. So I want to thank everyone here for showing up nice and early. I want to thank LinkedIn for hosting a beautiful day, and I hope you have a great day. And come back this afternoon, because I'm going to have a little fireside chat with Mr. Ed Gilligan of American Express. So thanks very much.